conversation with Dr. Anantha Nageswaran, Chief Economic Advisor to the government and the man of the moment. Dr. Nageswaran, thank you so very much for taking time out for us on this very busy day. So, to begin with, I do want to ask you that while you have outlined reasons for your cautious approach on the GDP forecast for this year, do you expect stronger consumption as well as private investment and the contribution of government spending to then come down?
No, I think you have spelling out the specific elements of GDP growth. I think it's difficult to say where the impact will be. But what we point out is if the monsoon turns out to be patchy and uneven, it will have some implications for rural consumption and rural income growth. And separately, geopolitical disturbances and the manufacturing challenge being posed by China, and given the excess capacity that is out there, creating the potential for imports increasing in a big way, I'm not saying will, but may induce some caution on the part of the private corporate sector with respect to investing. So it may affect the growth rate. It's not necessarily the absolute amounts being invested. It may affect the growth rates of corporate sector capital formation as well.
Okay, all right. So also your comments on equity markets suggest that the Indian market is overheating. You have spoken about, a cautious approach for retail investors that's needed and the expectation of greater returns, not aligning with real market conditions. So one, I do want to ask you if the implication is that markets are currently overheated, and also on derivatives. The problem now seems to be well identified. Why is policy action then lagging? Have you already let it run too far, and what is the policy prescription in that case?
Look, I don't think, first of all, about the market valuations, etc., I don't comment on it, and I haven't commented specifically on financial market valuation in India. I simply said that financial market valuations in the developed world have become elevated, and there seems to be some sort of a caution that is creeping into the marketplace, and normally when the developed country markets correct, they do have a spillover effect in developing countries, and Indian market has run up a lot in the last several years, and there is therefore quite an appropriate condition for profit taking to happen, etc. So it is not about valuations in India per se or the growth opportunities, but what is happening elsewhere can have a spillover effect here as well. That is one. And second, whether the situation with respect to Indian retail participation in F&O has it already gotten out of hand, I don't think so. It is not a systemic concern, but we actually don't want it to become a systemic concern. If you look at what the central bank did in December with respect to raising the risk weights on unsecured personal loan, that was a preemptive action. It is not that things have become out of control at the time. It did not want things to become out of control. That's exactly the kind of stronger for longer kind of action that needs to be taken, and also it is in the interest of both the retail investor and capital markets and the private sector with respect to capital formation that we ensure that the financial savings are channelized into productive investments, both from the point of view of the investor and the corporate sector.
Okay, all right. So the report today has a lot of interesting commentary on the China Plus One policy. Now, you've sort of articulated about the benefit of FDI from China and why that can be encouraged. But can you tell us a little bit more about that? And also adding to that, does it sort of run contrary to what other parts of the government might be feeling about China-related investments?
No, we are not contradicting anyone here. We're simply pointing out the possibility that if we continue to rely on imports from them, it's not that as if we are not having a relationship with them. We are importing a lot of goods from China, and that's why our trade deficit with them bilaterally are running close to about $90 billion. So there is a relationship, there is a commercial relationship. We're simply asking the question whether there could be a better balance, because continued reliance on imports can also have implications for domestic manufacturing growth to happen, investments in the manufacturing sector to happen. Because of excess capacity, because of China's continued presence in low value added goods, etc. If we continue to import them, then we will, and importing from them is actually cost comparative, cost attractive, and therefore that will continue, which will naturally delay the creation of manufacturing capability domestically in those areas or even in medium and high-tech areas. So that's a choice we need to make. What kind of engagement we need to have? We have an engagement, and that is trade-based. We are asking the question whether that is conducive for other goals that India has. Even not only with respect to investment and manufacturing, but also with respect to managing climate change and energy transition. So we are only raising these questions and asking that maybe there is a need to look at a better balance between importing goods and importing capital.
Okay, all right. Now, I'll try and squeeze in one quick last question before I can let you go. But, I do want to ask you about jobs. You've spoken about the improvement we've seen in economic indicators. We've seen a decline in unemployment rate alongside a rise in labor force participation. But I do want your help in understanding, how do you read this against the rise we've seen in self-employment? Within that as well, we've seen a rise in own account workers, helpers in household enterprises, and that along with the share of salaried employees having fallen a tad bit from about 23.8% in 2018-19 to about 20.9%. Not a fairly steep decline, but I do want some help understanding that.
Sure, I think it's a fair point. I think we can have both of them happening in parallel. You can have increase in own account workers, by the way, but even though there's increase in own account workers, on account of domestic work has come down. It's some of them are actually become their own employers. And secondly, I think we should remember that between 2013 and 2019, we had the balance sheet issue in the corporate sector and the banking sector, immediately followed by the pandemic, which saw reverse migration happen, and plus women coming into labor force in rural India, etc. So the two big shocks have created distortions, and that we should not let those two big shocks influence or cloud our judgment about the structural capability of the Indian labor market. Now that these two shocks are behind us and are fading away, I think the economy will see a resumption of job creation in the right areas of the right quality.
Okay, all right. Thank you so much, sir, for taking time out to speak to us today. We're very grateful.